CNBC-TV18. Let's talk money.
Election 2024, a verdict that has reminded us that there is no place for complacency when it comes to investing. Surprises can happen, and linearity is a concept perhaps best not associated with the stock market. Hello and welcome to another edition of Let's Talk Money. You guessed it, this is the election special. I'm your host, Surabhi Upadhyay. India has decided, and the verdict didn't go down too well with the market, as we all saw on Tuesday, with the Nifty cracking over 6% on counting day. So now the fractured mandate is upon us. There is some uncertainty with respect to policy continuity, and we've been flooded with a lot of questions on what we should be doing with our personal finance portfolios, with our funds, with the way we're looking at our financial management. To help us answer a lot of those questions, we have with us two special guests in the studios with me today, Radhika Gupta of Edelweiss Asset Management, as well as Ashish Shanker of Motilal Oswal Private Wealth. Thank you so much both for joining in. I know it must have been a real busy roller coaster, 24 hours for both of you. Let me start there. How was it, Radhika?
It was a busy 24 hours, although I think you folks in the media probably had it a little busier, because at least for us, markets end at 3:30. But I think having done this for almost 20 years, this is the reality of capital markets. This is the reality of events, and it's a constant reminder, I think, that India is a very diverse country and a democratic country, and a lot of different things can happen, not all of which we can predict. So markets humble us, and we need to constantly be prepared for events and to be humbled.
Absolutely. Ashish, when, things were falling yesterday, 1,000 points, 1,500 points, I don't know, were you getting a lot of calls? Typically in the past experiences, all the dips were bought. Yeah. Was it different this time?
So, like she said, the last 3-4 days have been extremely exciting. And it just tells you one thing, predicting markets, weather, and elections is extremely difficult, right? So I think one should refrain from doing that. Yesterday, I think people were really, first of all, surprised at the results and the way the markets fell. So there was not too much activity. I mean, there were some people waiting on the sidelines who took the opportunity to buy and load up on equities. But generally, it was a day of less activity. I guess people want the dust to settle in, and over the next couple of days, we will get some clarity also on the government and the continuity of policies, etc., etc. I think post that, people will decide what to do on their portfolios.
Okay, fair enough. Now, the objective of the next 20 minutes is to try and answer a lot of questions. Also, give people some advice on the kind of mutual funds that are must-haves in their portfolio. And I know, we've been speaking over the years with both of you, and it is about individual asset allocation, right? But before we get to all of that, I want your thoughts on a broader question. Now, what is real is that we have probably a coalition government coming back to the center, maybe not with as decisive and a clear mandate as before. Does this mean that the market's texture and fabric will change? Because post-COVID, we've had one kind of market, with one kind of government ruling at the center. Are we in for a new market altogether? What do you think, Radhika?
Potentially, although it is early to tell, and I don't like extreme opinions. So it's not that old is going, it's not black and white. I think a coalition government definitely means political policy, and the ability to push large-scale political reforms is far more challenged. Now, in India, I think the history of economic policy has been far more consistent. If you look at between UPA and NDA, many policies that started perhaps as UPA policies, I take GST, I take IBC, they've been carried over. Yeah. Very rarely, and this speaks really well for India, has economic policy been overturned by any government. So I think meta change in economic direction hopefully will not happen. Where I think a little bit of change could happen is that in a coalition government, there are needs of coalition. The rural economy has been relatively weak. So some of the noise and compulsions around consumption, we have to see if those will play out, and some budget will shift from capex. But as I said, it's too early. We have to see the government that finally forms, the cabinet that forms in the 100 days of the government, but a little more shift to the middle.
Okay, fair enough. Ashish, a lot of money has been made, right? Since the COVID low, I think 7,800 on the Nifty thereabouts, the absolute bottom.
Right.
From then onwards, a lot of money has been made. Do
Yeah.
you see that continuing, or does it change?
So I think the underlying fabric of the economy doesn't change, right? The potential that exists in terms of growth, in terms of the consumption potential, etc., doesn't change. But what tends to happen is, see, in a digitally connected world, opinions and markets get extremely polarized towards one side. And all of us knew that the certain sectors were really overvalued and they were exhibiting exuberance. Now, in hindsight, we may look back and say maybe election was the event which changed that.
Yeah.
So I think some sanity will return to valuations in sectors which were overbought, and you will see some rotation. And, these are times when people are reminded that basics are important, right? Having a diversified portfolio, having asset allocation. Otherwise, when markets go one way, I mean, people just ignore the basics and they just want to ride it as much as possible.
No, absolutely. And, with that, on the point of asset allocation and coming back to basics, I'll take the first question. Yep. I think it's in sync with what the both of you are saying. This is a, email, I think, no, this is an Instagram query that we've got from Sam, one of our viewers. He's saying that with such a fractured mandate, should one be looking at, moving to safe havens? And what are those safe havens that investors can talk about? Imagine that. I mean, until I think June 3, it was all about, fresh all-time highs. And now safe haven is back in the chatter. Radhika?
I have been, and I've been saying this for the last few months, I've been a big advocate of something called the middle path in investing. And I get very scared by this. 2 days ago, PSU funds are amazing. But a year ago, if you had looked at the 10-year return on PSU funds, I think it was single digits. And then we jumped from PSUs to safe havens because I think people get the timing of this extremely wrong. In fact, large thematics come out at this time, raise a lot of money. So I think the timing is wrong. The middle path is a lot more powerful. As Ashish said, I don't think the fundamental thesis on India's economy changes. Because I believe India's story is a demographic story, it's a consumption story, it's an entrepreneurship story. Policy should support that. So that doesn't change. How do you leverage that? You leverage that by funds that are the middle path, which are your boring, diversified funds that don't have large skewness. Because the last few days have shown you the pain of being on extremes. Yeah. So I'm really an advocate of being in the middle path rather than shifting up and down. You also end up paying a lot of taxes and loads when you do.
Ashish, your thoughts on what's a safe haven in this environment?
So I'm just connecting this with our view, which we put out at the beginning of the year, right? The note that we write in Alpha Strategist. So we called this year the year of the all-rounder.
Yeah, I remember that.
Where we believe that given the event-heavy year that we have ahead of us, you should be allocated in different asset classes, right? So multi-asset funds is something that everybody should have in their portfolio. Okay. And there is even more case for multi-asset funds because the taxation on debt funds has changed. So it can give you a similar kind of outcome with better taxation. Of course, a little more volatility because you have some allocation to equities. So we continue to be extremely positive on multi-asset funds for the part of the portfolio that you want it to be steady and you want a double-digit kind of a return. As far as equities are concerned, we had put out a view that sometime back that you should probably be more allocated towards large cap funds and flexi cap funds because large cap funds give you the stability and the flexi cap funds, the fund manager has the flexibility to move across market caps depending on valuations.
He or she may see,
and secondly, pre-elections we had put out a note saying that from here on, whatever portfolio you want to build around equities, you should probably stagger it over the next 6 to 12 months, given where valuations are and given that you also have another big event coming your way sometime in October, November, which is the US elections and which sets the tone for the rest of the world. So I think multi-asset funds, some allocation in asset classes like gold, and if you want to do equity, then flexi cap and large cap funds are probably a better bet going forward.
The way to go.
In a staggered manner.
Just remind us about the taxation benefits of multi-asset. Will they always enjoy equity taxation or is it?
So the multi-asset funds now enjoy the erstwhile debt taxation, which is if you keep it for more than 3 years, then you get indexation and you're taxed 20% on the post-index gain. So the effective taxation could come to around 7-8%. So they are a much better bet for people who want to do asset allocation in their portfolios through mutual funds than the erstwhile debt funds where you will end up paying full marginal tax going forward.
Okay, I think that's a great point and a great example. I mean, that could be one place, a safe haven, or basically an area that could provide some stability and support to your portfolio. Okay, now the debate around thematics is not over. In fact, it's not even started, and I'll tell you why, because we have a question coming up on this. I think we have Mr. Jagdish Kumar with us on the phone line, and I believe his question is on thematic investing. Mr. Kumar, welcome to the show. Thank you for joining us. Tell us, what's your question?
Hi, this is Jagdish Kumar. I'm from Patna, and I was wondering whether I should start selling my defense stocks that I procured over the last month, considering the current mandate and the recent rout in the past 2 days in all the defense stocks.
I think that's not just Mr. Kumar's question. Thanks for the question, sir. But I don't think it's only his question. It's probably the question of half the viewers, because everybody was, loading up on these stocks. And if you weren't buying them, you were feeling foolish, and then you've bought them. And now there's this big reversal, big dilemma.
So I think one of the mistakes that happens in this market is between thematic funds and niche thematic funds or stocks, plus allocating to funds that have done well in the last year. And if they've done well in the last year, they're likely to be loaded up on some of these. You actually are not that diversified. And I'm saying this because I think it's something for viewers to keep in mind and think of genuine diversification. On thematics, my view is, I think there is a core and satellite approach to portfolios. Now, I've always said I get very nervous about niche themes because they are very cyclical, and people's ability to enter is still okay, but to exit is a disaster, and very few people give you sell calls on that. So I think thematics, niche thematics, if you want to do it, should be 20% of your portfolio. The 80% should be, my boring word of dal chawal, diversified funds, hybrid funds. If you have to do thematics, structural thematics that are long-term, financials, tech, consumption, but
like themes that never go out of fashion.
Themes that if India has to do well, then digital, India consumption, financials, these have to do well. So if you have to do themes, do that. But this, if you want to have that fun in life, should be confined to 20%.
No more than 20%.
No more than 20%.
What would you say to viewers who are in these funds?
Just to build on her point, see, I understand the urge to invest in something which is moving, because if you don't do that, how will you have bragging rights, right, with your friends? So I think,
or also, if I could, bat from the investor's side, also it does make the return look so good. And when these stocks have gone up 300, 400%.
Yes, but see, if you take a slightly longer time frame, right, very few thematic funds have made money on a consistent basis. So there are certain sectors which are structural in nature, for example, consumption or NIT, or for that matter, pharma. They have delivered value, but there are periods where even they go through extreme underperformance. So I think, see, 20-25% of your portfolio where you're trying to apply your intellect and trying to catch the moving sectors is fine. But I don't think you should do it with a large section of your portfolio. And coming back to, this gentleman's
specific query on
defense stocks, look, first of all, I don't know the rationale on which he or she bought the stock, right, in the first place. So if you don't know why you've bought the stock, it's very difficult to decide whether to sell. Now, the other thing is, I don't know what is the allocation of these defense stocks in his portfolio, right? If it's a very small portion in his portfolio, then maybe he can just sell and move on and try to catch the next moving sector. But if it's a large part of the portfolio, then there is a very strong case for him to sell and diversify into certain broad-based themes or funds.
Okay, so let me turn the question around for the larger sort of percentage of our viewers. Let's go with Radhika's rule, saying don't make thematics more than 20% in any case. Within that 20% allocation, would you still keep PSU funds or defense funds or these capex or sort of manufacturing sort of funds?
See, I'm not a big fan of these themes because these themes tend to be extremely cyclical, right? They go through periods of extreme underperformance and they go through periods of extreme momentum, right? Which is very difficult to time. But themes like IT, consumption, healthcare, these are more structural, longer term in nature. And generally, if you pick up, let's say, 10 out of 20 companies in these sectors, right, they will all have ROEs greater than 15, 16%. So in terms of quality, there is no problem. But same thing, if you take a capital goods or a manufacturing theme and you take 15 out of 20 stocks in a bad time, their ROEs will be negative. Or they'll be low single digit. So your ability to make money consistently on a longer term basis. So this is for probably very professional investors who understand themes, who understand market, stocks.
Timing.
Even their mutual funds is a great way to participate because instead of going and buying individual stocks, today you have thematic funds in every sector.
Correct.
So you can just pick up a fund and exit becomes simpler.
Absolutely. Got it. So we do have to take a break on that note. But on the other side, I've managed to pin down Ashish to give us some names as well, fund names, because a lot of you are asking where to put fresh money to work. So we'll get to that in just a bit after the break.
Let's talk money.